There are 3 accounts where the IRS collects nothing, not $1 in tax when the money comes out. Most retirees own one of them and use it wrong, and almost nobody uses all 3 together. Get this right, and you can pull tens of thousands of dollars a year and legally hand the taxman a bill for zero. Quick note before we start. I'm Uncle Ray, an animated character I created, and this channel is education, not advice. The numbers here are checked against IRS figures for 2026. But your situation is your own, so always run it by a qualified tax pro. Welcome back to the Retirement Desk. Grab your coffee and settle in, because today we're talking about the 3 accounts the IRS simply cannot touch, and exactly how Frank and Carol use all 3 to keep their tax bill close to zero. Here's the thing almost nobody tells you. In retirement, it is not what you have, it's what you keep. 2 couples can retire with the exact same nest egg, the same $1 million, and one of them hands the IRS thousands every single year, while the other pays almost nothing. Same money. Completely different outcome, and the whole difference comes down to one thing: which account they pull their income from. Most people spend 30 years learning how to grow the pile, and almost no time learning how to take it out. That's the mistake, so let's fix it. Starting with the 3 buckets the taxman can't reach. Account number 1, the Roth. You already paid tax on this money on the way in, which means on the way out, the IRS gets nothing. If you are at least 59 and a half and the account has been open for at least 5 years, every single dollar you withdraw is 100% tax-free. The growth is tax-free. The withdrawals are tax-free. And here is the part that quietly makes it the best account in the entire tax code. A Roth IRA has no required minimum distributions. A traditional IRA forces money out starting at 73, whether you need it or not, and taxes every dollar. The Roth never forces you to touch it. It can keep growing, tax-free, for the rest of your life, and then pass to your children tax-free as well. That is why the wealthy quietly pour money into it. One quick note on that 5-year rule. It's about how long a Roth has been open, not the exact dollars you put in. And when a Roth passes to your kids, they'll generally need to empty it within 10 years. But here's the beautiful part. They still pay 0 tax on every dollar. Now, if most of your savings is still in a traditional IRA, don't worry. You can move it across a little at a time. It's called a Roth conversion. You pay some tax on the amount you move now in a low-income year, so it grows tax-free forever after. The sweet spot is often those quiet years after you retire, but before required withdrawals and bigger Social Security checks kick in. Account number 2 is the one almost nobody thinks of as a retirement account at all. The Health Savings Account, the HSA. And this one is special because it is the only account in the whole tax code with a triple tax break. Follow the money. It goes in deductible. That lowers your tax today. It grows tax-free. No tax on the gains year after year. And it comes out tax-free, as long as you spend it on qualified medical costs. Deductible in, tax-free growth, tax-free out. Nothing else in the code does all 3. In 2026, you can put in up to $4,400 on your own, or $8,750 for a family. And once you're 55, an extra $1,000 catch-up on top. Now, here's the retirement magic. Medical costs in retirement are not a maybe. They are a guarantee. Medicare premiums, dental work, hearing aids, glasses, long-term care. Your HSA pays every one of those with tax-free dollars, and there's a quiet trick the savviest savers use. Don't spend it as you go. Invest it, let it grow, and save your receipts. You can reimburse yourself years later, tax-free, for bills you already paid. After 65, if you ever pull it out for something that isn't medical, it simply behaves like a regular IRA, ordinary tax, but no penalty. So worst case, it's a normal IRA. Best case, it's completely tax-free. There's really no downside. Two more things worth writing down. When you sign up for Medicare, it can backdate your coverage by up to 6 months, so stop your HSA contributions a little early to stay clean. And that $1,000 catch-up is per person. If you and your spouse are both 55 or older, you each get one, but each has to sit in that spouse's own account. The bottom line on the HSA, the day you enroll in Medicare, you can no longer add new money. So the game is to fill it up in the years before. Account number 3 is going to surprise you because it isn't a special account at all. It's your plain, ordinary brokerage account. The regular investment account almost everyone assumes gets taxed to death. Here is the secret: the IRS does not put on a billboard. Long-term gains, anything you've held for more than a year, and qualified dividends do not use the regular income tax rates. They ride their own separate schedule, and the very bottom rung of that schedule is 0%. In 2026, if your taxable income stays under $49,450 as a single person, or $98,900 for a married couple filing jointly, the tax on those long-term gains is 0. Not a lower rate, 0. You could sell an investment that doubled in value, and if you're under that line, the IRS takes nothing. Now, one detail people miss: that line is your taxable income after your standard deduction comes off. So your actual spending can be quite a bit higher, and you can still fit underneath. This move has a name: tax gain harvesting, and it's one of the most powerful and least used tools a retiree has. You can even sell and rebuy the same investment, reset your cost basis higher, and pay nothing to do it. A couple of guardrails, though. Those gains stack on top of your other income, so if a pension or big withdrawals fill the space first, there may be less room at 0 than you think. And realizing gains still raises your income for the year, which can nudge your Social Security taxes or Medicare premium, so you harvest with a target in mind, not blindly. All right, let's put all 3 together the Frank and Carol way. Because one account is good, but the 3 working as a team is where the real magic happens. Frank and Carol are both 66. Married, retired, and they need about $90,000 a year to live comfortably. Watch the 2 paths. The ordinary way is to pull all $90,000 out of a traditional IRA. Every dollar of that is taxable income. It can drag more of their Social Security into being taxed. It can even push up their Medicare premium, and they hand the IRS a real bill, easily north of $8,000 or $9,000 a year, money that's simply gone. That's the expensive path most people walk without knowing it. Now watch the 3-bucket way. They take $40,000 from the Roth, tax-free. They pay their Medicare premiums and medical bills, about $10,000 straight out of the HSA, tax-free. And the last $40,000 comes from their brokerage account, where roughly half of it is long-term gains. Because their taxable income is being kept low. Remember, the standard deduction alone is $32,200 in 2026. Those gains fall right into that 0% bracket. So on that entire $90,000 of spending, their federal tax bill rounds to almost nothing. Same house, same lifestyle, same size nest egg as the couple down the street, but a tiny fraction of the tax simply because they pulled from the buckets the IRS can't touch. So let's lock it in. Nice and simple. 3 accounts the taxman cannot reach. Number 1, the Roth, tax-free on the way out, and no forced withdrawals, ever. Number 2, the HSA, the only triple tax break in the code, paying your medical bills with tax-free dollars. And number 3, the 0% capital gains lane, hiding inside your ordinary brokerage account. Here's the sad part. Most retirees own the first one, ignore the second, and have never even heard of the third. But now you know all 3. Use them on purpose, together, and you decide what the IRS collects instead of the other way around. Now, one last thing, and it's important. Having these 3 accounts is only half the game. The other half is the order you pull from them, year by year. Get that order right, and you can stretch tax-free income out for decades. That's a whole video of its own, and it's coming next. So make sure you're subscribed. And remember, Uncle Ray is a cartoon. This is education and not advice. So please run your own numbers with a qualified tax professional before you move a single dollar. If this helped, hit subscribe. And tell me in the comments, which of these 3 accounts do you already have? 1, 2, or all 3? I read every one. I'll see you at the next retirement desk.